Well, good morning, everyone. Happy to have you join us today as we go through select highlights from our 2025 financial planning guide. Happy to be joined today by Mike Emerson, a partner in our private client group, and our CEO, Sabrina Bailey. Welcome, Mike and Sabrina.
Thanks for having me, Nick. Looks like we've got record attendance today and a great group to present to.
It'll be a great group.
Yes, thank you, Nick.
When we think about holistic wealth management and wealth planning, really important to think not just about your investment portfolio, but a lot of impactful planning areas. So our goal for today will be spending a couple minutes in each of these planning areas. There's more information available in our full 2025 financial planning guide, but really to provide you with nice, actionable planning insights. I'd encourage everyone to enter questions in the chat box. We'll do our best to carve out some time at the end for question and answer. And then for those that need continuing education credit, there'll be a form in the chat box that you can fill out to apply for 1 hour of CE credit. Before we dive into today's presentation, we thought it'd be helpful for Sabrina just to give a quick overview on Fiducian Advisors for those of you that might have less familiarity with our firm. Sabrina?
Wonderful. Thank you, Nick. And we're grateful to have all of you with us today. In terms of a high-level overview, I'll update you on our firm's progress, and then I will be turning it over to Mike Emerson to walk through the financial planning highlights. First and foremost, our mission has remained steadfast for almost 30 years, which is helping our clients prosper. We accomplish this by focusing on our core areas of expertise, including serving middle market corporations, financial institutions, endowments, foundations, families, and individuals. And our team has been structured with experts dedicated to each of these areas of service to ensure our clients received tailored and impactful solutions. In terms of a snapshot of our firm, if you'll focus on the top half of the slide, we have over 200 associates today that span various disciplines, from investment consulting to research to operations. We proudly serve over 1,200 clients, and this represents a combined $330 billion in AUA, AUM across 47 different states. Notably, 20% of our employees are owners of the firm, and we have a robust pipeline of next generation leaders we're excited to continue to bring up throughout the organization to serve all of you. Why does this matter? It matters because our breadth and depth allows us to view your challenges as our challenges, and your success is tied to our success. You have direct access to this breadth and depth of expertise, some of which you'll be hearing today on the financial planning front. And our experts are passionate about helping you succeed, whether that's leveraging our internal capabilities or connecting you with industry experts to provide support on solutions that you're looking for. In terms of milestones for 2024, on the bottom half of the slide, we've celebrated really significant achievements across all of our business lines, experiencing organic growth across every business line and adding more than 125 new clients in 2024. We also launched our first annual client satisfaction survey in 5 years with excellent results that directly inform how we're thinking about service enhancements to our clients based on your voice. And then finally, we've had new solutions that we've launched this year, really driven by our clients. Those solutions include a financial wellness platform to help employees take ownership of their financial outcomes, pooled employer plan solution for retirement clients seeking to move in that direction, financial planning services for our executives through our executive CFO program, and new investment solutions in the alternatives asset space. Your feedback drives our best ideas, so we're going to ask that as we move through 2025, please keep sharing your ideas with us. And if there's anything else we can assist with, do not hesitate to reach out. Finally, I'll talk about our investments in our people and culture. From a colleague perspective, we launched career pathing initiatives this year, which really supports individual growth. And we've also introduced our firm's guiding principles, upholding excellence, embracing growth, demonstrating care, and cultivating joy, which complement our core values of service, collaboration, and expertise. Finally, we continue to invest in technology to maximize the time our team can spend with you in value-add areas. And we remain actively involved in the communities. that we serve in. So as we look forward to 2025, we're excited to be announcing our new partners and principals in the next month. We have a focus on continuing to serve the communities in which we operate in and deepening our partnerships. And finally, continuing to service our clients. In September, on September 17th, actually, we're hosting our annual client conference in Boston, and we'd love to see you all there. So in closing, we are excited to deepen relationships. We're excited to hear from you. And now I'm looking forward to turning it over to Mike Emerson to walk you through our financial planning highlights.
Thanks for that overview, Sabrina. I think it's safe to say we're all excited about where the firm is as well as we're going. I do want to take a quick second and just brag about our private client practice and team. Our group alone represents clients in 40 states and growing. We're well staffed to ensure top tier service with a 16-to-1 client to employee ratio. Our team alone services 29 billion assets under advisement. And I think the big differentiator for us versus other groups is going to be how well credentialed the group is, with 5 CFA charter holders, 13 CFPs, and 1 JD. Flipping forward, if you'll excuse the pun, we do have a wealth of articles, white papers, and thought pieces. We call it our timely updates and actionable insight section of the website. We would encourage you to visit it. If there's information you're looking for, hopefully you'll find it. You'll potentially find information you didn't know you were looking for. And if it's not available, certainly let us know. We're always looking for new ideas on content to create. If you're thinking about it, there's likely another client that thinks it's important as well. So feel free to pass those along. With that introduction, I will pass it over to Nick to get the session started and give us an update on tax planning.
Thanks, Mike. As we turn our attention to 2025, I think one of the things that's certainly front and center on the minds of individuals is certainly what happens with the Tax Cuts and Jobs Act. So as a quick reminder, the provisions from the Tax Cuts and Jobs Act went into effect in 2018. The personal tax provisions were set to expire at the end of this year. There's been a lot of questions as far as what happens with tax policy going forward. We would say under a second Trump administration and a now Republican-controlled Congress, it looks likely that Congress will push to extend or perhaps even make some of these tax provisions permanent. So something that we're watching closely and something that you should be watching closely too as 2025 unfolds. As it relates to estate planning, the lifetime gift tax exemption increased by $380,000 to a new limit of $13.99 million per person. So for those that had previously existed, the lifetime gift exemption, there's additional capacity to get additional assets out of one's taxable estate. Now recall that this is a provision that is set to expire at the end of 2025 and reset to a new base limit. But again, it looks like Congress is positioning to extend what was previously thought to be a sunset at the end of 2025. Good news for those that are still saving for retirement. Secure Act 2.0 includes a new provision for 2025. For those that will attain ages 60 to 63, there's an enhanced or souped up catch-up contribution. So whereas the age 50 plus catch-up contribution to 401k, 403b, and 457 plans is $7,500 for 2025, this super catch-up contribution limit is $11,250. So do keep that in mind if you're still maximizing retirement contributions. And then we also wanted to make a quick note on the Corporate Transparency Act, which garnered a lot of headlines in 2024. So this was a provision that was set to go into effect in 2025 that would require beneficial owners of businesses, LLCs, and other entities to file a report with FinCEN. However, in early December of 2024, a Texas-based federal court issued a nationwide injunction, which really put the provisions of the CTA on hold. So something that we're continuing to watch for further guidance. On the charitable planning front, we continue to see charitable bunching remain effective. As a reminder, the Tax Cuts and Jobs Act dramatically increased the standard deduction, so far fewer individuals itemize deductions. The estimate is something like only 10% of taxpayers actually itemize deductions now. But there's a lot of individuals that are still charitably inclined. So charitable bunching is effectively where you're giving multiple years worth of charitable gifts into a single tax year to produce a big itemized deduction total, and then taking the standard deduction in subsequent years. So again, can be an effective planning tool for those that are charitably inclined. Given that we're still in an elevated interest rate environment, we are seeing the opportunity for advanced planning strategies such as charitable remainder trusts and qualified personal residence trusts. And then finally, we see intrafamily loans still remaining popular. This has been a tool that we've seen a lot of clients take advantage of as it relates to helping the next generation with a home purchase. If you looked at the end of 2024, there was a pretty big spread between traditional mortgage financing and the governing rate that sets the minimum rate that you can provide an intrafamily loan. So if we look at as of last December, traditional mortgage financing was hovering close to 7%, but the long-term, what's called the applicable federal rate, stood at 4.53%. So that differential really provides an opportunity to provide family or loved ones with greater home affordability options. As it relates to actionable planning insights for tax planning purposes, we always remind clients that variability in year-over-year taxable income can provide an effective planning opportunity. So for those that might find themselves in a year where they have higher than normal taxable income, that provides an opportunity to potentially accelerate itemized deductions, namely charitable gifts, to possibly defer certain income items such as the payout of a bonus, the sale of a business or stock option exercises. In a higher income year, you certainly want to be thoughtful about managing realized capital gains and, to the extent available, harvesting tax losses, and then certainly maximizing retirement contributions. Conversely, if you find yourself in a lower than normal taxable income year, it might benefit you to defer itemized deductions, again, namely charitable gifts, to accelerate certain income items, whether that be a bonus payout, perhaps option exercises, to realize capital gains up to a certain threshold, and then to potentially consider a Roth conversion. We always remind clients of the importance of gearing a portfolio for tax efficiency. So if we take a step back, it's important to remember that certain asset classes have different tax treatment. And as a result, where you hold certain asset classes among your portfolio can have a pretty impactful difference. So this is something you may have heard referred to previously as asset location. And instead of holding the same investments throughout all of your investment accounts in a portfolio, really important to take a step back and think about your portfolio as really a combination of different buckets. So Roth accounts, traditional retirement accounts, and taxable accounts. So putting this into practice, when you have a Roth account, you really want to gear it for maximum growth. So primarily allocating to global equities and other high growth strategies. Next, we look at traditional retirement accounts, and this is where we typically are going to want to allocate to less tax efficient asset classes. So you can think of high yield bonds, dynamic bonds, US core taxable bonds, and REITs. And then finally, we look at taxable accounts. How do we round out the portfolio allocation to get to a desired target allocation? So what are key questions you should be thinking about on the tax planning side? First, are your itemized deductions providing significant tax savings? Again, this speaks to my prior point on charitable planning, really getting a firm understanding of your charitable giving and to what extent is that really providing meaningful tax savings. Second, is your portfolio allocated for tax efficiency? And then finally, how might your tax picture change after retirement? Really important to have good planning conversations with your accountant or trusted team of advisors in the years leading up to retirement, and to take advantage of tax planning strategies while you're still in a higher income tax bracket. Turning our attention to charitable planning, the good news is we see that charitable giving continues to increase pretty considerably. We see families giving more money for longer periods of time and with greater flexibility. As asset values have increased pretty considerably over the last couple of years, we see the value of non-cash charitable contributions continue to increase. And we see charitable giving really being embraced by families from a philosophic perspective as a way to really tie families together as far as what are important organizations that they wish to support. From a planning perspective, there's a number of different charitable giving vehicles that one might consider. So oftentimes individuals will opt for the convenience of writing a check or making a credit card donation, but there might be other avenues to consider. So as we've laid out here on this slide, we've seen a number of clients take advantage of donor advised funds, which is a great way to simplify charitable giving. Some clients opt for a private foundation, and then among advanced planning opportunities, charitable lead and charitable remainder trusts. So what are key questions you should be thinking about in the charitable planning front? First, where should you start? What are organizations that you're passionate about, and how much would you like to support them? What types of assets should you consider gifting? For individuals that have highly appreciated securities that are long-term in nature in a taxable account, those can really be ideal securities. to give to charity. And then finally, what charitable giving vehicle is right for me? Should you pursue either a donor advised fund or private foundation, or perhaps something that involves more advanced planning? With that, I'll turn it over to Mike, who will walk through retirement planning.
Thanks, Nick. That charitable focus is certainly topical for most clients at this point. And as we transition towards retirement, it's certainly part of human nature to wonder, do I have enough and how much am I going to need? Everything's going to be individualized. Each person has their individual goals, but I think in common, everyone has the want and need to have a comfortable retirement and really not have to worry about their money. So we can make financial planning a really simple exercise if you can guarantee how much you're going to spend and when you're going to die. But the irony of that is really the uncertainty between those two factors is what we're planning for at this point in time. So at Fiducient, we advise to take a very conservative approach to help minimize the risk of outliving your money. Several key factors we've laid out here are going to be the longevity that you're going to experience, whether that be through your family history. How long did your parents live, your grandparents live? We've noted that humans are now living longer. The average life expectancy is well into that mid-80s, which is going to impact both your savings rate, the income, the needs that you'll have in the future for spending as well. So a good exercise and very valuable to engage in would be taking a stock of your current budget, as well as putting together a retirement estimate. How much are you thinking you're going to need? Likely a cost that'll be underrepresented with that is going to be the healthcare costs. We've noted here that the average 65-year-old going into retirement should plan to spend roughly $165,000 exclusively on healthcare alone, and that will include Medicare, but other costs as well. So certainly a significant burden that can lead into retirement that many folks are just candidly not expecting. When we look at the spending and saving, we're going to look at that from a few different angles. In the bottom right-hand corner, we've noted the income replacement ratio, which is a recommended range of 75 to 85% of your pre-retirement income, being a guide for how much you should expect to spend on an annual basis once you retire. It's a general guideline, and as we flip to the next page, it's not perfect, but the graph we've put in place here is a rough guesstimate of, compared to your peers, how much should you have saved by a certain age? And as you go from left to right, you can find your age and pick that out. For example, someone who's 55 should likely have approximately 5 times their salary saved. And as you approach retirement at age 67, we look for that to be closer to 8 times. Again, this is just an over-under target. Really compared to what you have, there's still time to correct it. If you're over, that's great. If you're under it, there's still some work to do. Several common retirement mistakes that we think you can control, we've laid out along the right-hand side here. The first two I think are pretty intuitive. Saving too little, obviously, is going to lead to not having enough money in retirement. Starting to save too late dovetails into that. But retiring too early, a few years kind of at the back end there where you're aching to retire, but eking it out for a few more years and really earning some more as opposed to starting to dip into that retirement nest egg can make a big difference in the overall retirement plan. We do utilize financial modeling such as Monte Carlo to assist and inform some of those personal scenarios. So coming up with what are the wants, needs, and wishes, how much you can spend on those, and how much you should be bucketing for those. I think the last point we'll touch on in this slide is just the assuming too much risk. Again, that goes to, are you too concentrated? Do you have too much equities? I would also argue the converse is true, as we've seen with retirees, that having too little risk can upend your retirement plan too. So the investing timeline really definitely continues post-retirement. It's not the end of that horizon. It's really the beginning of that 20 to 30 year period where you need to account for those factors as well. That naturally leads into the question of, well, what can I realistically spend in retirement? And we've outlined the 4% rule on this slide. It's a pretty well-known guideline. It's not going to be applicable and it's not perfect for everybody, but what you're really doing is taking the market value of your portfolio, multiplying that by 4%, and that gives you a rough annual spend that you can pull from the portfolio on an annual basis. You may see it is important to work with your advisor to develop a sustainable spending rate based on your own time horizon, portfolio allocation, and risk tolerance. The 4% rule is not perfect, as I mentioned, but what we're trying to display on this graph as you go from left to right is that intuitively, if you want to have a safety net and have a margin of safety on what you can spend, typically the less is going to be the better. If you plan to check out in 10 years, you definitely have some more leeway, spending roughly 10% of the portfolio per year. But for most retirees who are going to be in 20, 25, 30 years of retirement, you'll see that spending rate converge closer to that 3.5%, 4% range. That leads us to where should you save, how should you save, and the age-old adage of diversification, not putting all your eggs in one basket. We certainly know that applies with investments, and it's less commonly thought of with your saving sources. So what we've outlined here is various buckets. Nick touched on them earlier, the after-tax, pre-tax, and the no-tax bucket. We would note that for high earners, it's likely not enough to only save to your 401k. So filling up these other buckets will definitely be beneficial. When you have these variability in the buckets, it does provide for some flexibility in spending in retirement, as well as passing some of that wealth to the next generation. So ideally, there's funds in those various different buckets. As Nick mentioned, having the thoughtful location of assets and the investments in the buckets can actually boost your tax efficiency, which helps for better after-tax returns. We have a saying in the wealth office that it's not what you make, it's what you keep. And so we do focus on what that after-tax return and gain is going to be. We won't spend too much time on this slide, but really this is just giving you an update on what the contribution limits were for 2025 and how they've been updated for 2025. As Nick mentioned earlier, if you are age 50 or age 60, your ears should prick up a little bit. There is the catch-up contribution for 50-year-olds, and new in 2025 is going to be that catch-up contribution for 60-year-olds as well. We would be remiss not to mention executive compensation, as we've found that can make up roughly 60% of the overall compensation for executives, and that's receiving options, RSUs, and other equity units. Obviously, that should be incorporated into your holistic financial plan. If it's not, give Nick a call and he can help you with that. But it is important to review the options and the vesting schedule and create a thoughtful plan for exercise, because that's going to inform your tax plan, which dovetails into your retirement plan and obviously informs how you're investing some of that money as well. We've noted here in this third bullet point that there is a significant amount of money left on the table by executives that miss their key windows for exercising or allowing these options to expire. At this point, less than half of executives are taking full advantage of their granted options, which is pretty alarming, given the fact that we're here trying to talk about how do you maximize your retirement benefits and just leaving those there on the table. Several questions you can ask your advisor. We've touched on several of these, but it's going to be a more in-depth conversation. Do I have enough savings to retire? Does my portfolio allocation meet my longer-term goals? And how might my savings last relative to my income needs?
Great. Well, thanks, Mike. Really, as an extension of retirement planning, Social Security and Medicare are two certainly key planning areas. We're sometimes asked, at what age should I take Social Security? So as a quick reminder, for those born in 1960 or later, full retirement age is age 67. If you choose to defer receiving benefits, you receive what are called delayed retirement credits, where you get a plus 8% annual credit. That's a permanent improvement to your full retirement benefit that can be earned or accrued up to age 70. Conversely, if you choose to take benefits prior to full retirement age, as we've laid out here in the top half of the slide, you'll receive a permanently reduced benefit. So really important to have a strategy in mind when you're thinking about what age makes sense. For most individuals, it can be beneficial to delay Social Security to earn those delayed retirement credits to the extent that you have cash flow that can support you in those couple of years where you're waiting for Social Security to kick in. A couple key factors to consider in determining an appropriate age we've included in the bottom right-hand corner. So really factoring in life expectancy, what are income needs, what's your health insurance, factoring in spousal and family benefits, and what might happen from an employment picture. Medicare, another extremely important component. As Mike noted on his earlier slide, the estimate is that an age 65 retiree will spend $165,000 over their lifetime for healthcare expenses. So sometimes I think there's a notion that Medicare will pick up all health insurance costs or all healthcare costs in retirement, but that's not the case. So really important to have a good plan in place in evaluating your Medicare options. For most individuals, it'll be evaluating between original Medicare, which is Parts A and B, or the private health insurance alternative, Part C, Medicare Advantage. We have a relationship with a third-party provider named Chapter, where our clients have the ability to connect with a Medicare advisor to really review what are their prescription needs, what are their care provider needs, and evaluating an ideal plan. So what are key questions? We touched on this a little bit, but when should you start taking Social Security, evaluating key factors? How do you apply for Social Security benefits? And then what Medicare plan makes the most sense for you? Focusing our attention to estate planning. Estate planning is extremely important for a variety of reasons. First, it provides protection during your lifetime, so it enables you to name individuals that can act on your behalf to the extent you're unable to do so. Importantly, estate planning allows you the ability to distribute wealth according to your wishes or intentions. So without a proper estate plan, assets will be distributed according to state law, and that may not align with your intentions. For those with minor children, extremely important to name guardians for your minor children. For those with trusts, you have the ability to name a trustee as well as naming an executor to handle the ultimate settlement of an estate. And then I think one benefit of estate planning that sometimes gets overlooked is the ability to really incorporate a philanthropic legacy. So perhaps at the end of your lifetime, you want a special carve out of your assets to support a charity that's near and dear to your heart. I noted earlier the estate exemption increased pretty materially since the beginning of the Tax Cuts and Jobs Act. You can see this on this chart here as the base doubled. So currently $13.99 million per person, potentially dropping to $7 million per person if Congress chooses not to act and extend. Again, it seems likely that Congress is going to push to extend the current favorable limit, something that we're watching closely and something that those that potentially would have a taxable estate should be watching closely. So what are key questions you should be asking on the estate planning front? First, are your current documents in alignment with your wishes? We sometimes see clients make the mistake of having drafted documents years and years ago, but they haven't revisited those plans or updated those plans. Updates may be needed if you have a material life event that's happened, or perhaps you've relocated to a different state. So important to make sure that those estate planning documents are current. For those that have a taxable estate, what are strategies you should be considering to reduce your taxable estate? And then finally, from a philosophical level, is your family prepared to manage your assets when you're gone? Do they know who your team of trusted advisors are? Do you know how assets are to be managed thereafter? So with that, I'll turn it back to Mike, who will walk through education planning. Oh, Mike, you're on mute.
Age-old Zoom issue. If you're like me and you do have young kids, this could be your favorite section or your least favorite section. We're going to talk about how outrageously expensive college has gotten. As noted, the rising cost of college has actually outpaced inflation for decades now at this point in time. So investing early can help alleviate some of that financial burden, both on you as the parent or the grandparent, and also help with the student down the road, minimizing student loans and debt that they may need to take on to pay for secondary and upper level education. It is important to understand the costs as primary school has now gotten more expensive. The chart we've chosen to focus on here is going to relate to college. We've broken this out by various different ways you can attend college, whether that be public 2-year all the way up to a private 4-year on campus. But the takeaway is that those individual components, particularly on the private on-campus 4-year institution, are now costing north of $60,000 on an annualized basis, and that's in today's dollars. So pretty staggering amounts. We want to think about how can you actually combat that. And as you know, the early bird gets the worm. Getting an early start really can help with that. So we've pointed out on that next slide, the more time you leave for investments and give them to grow, allows them to compound and chip away at what you actually need to contribute to that fund. So having the flexibility and the ability down the road to contribute more or potentially less, depending on how your cash flow plays out. One of the common questions that clients always ask is, how much should I actually put away? I don't want to oversave, but I also don't want to material undersave and miss some of the benefits within a 529 or other plans. What we've laid out in this chart along the right-hand side is the color-coded amount. If you were to contribute $100, $250, $500, or $1,000 per month over the 18-year lifespan before you go to college at a 5% return, that gives you some context for what that money could potentially grow to. So the takeaway from this is going to be, if you were eyeing that 4-year private on-campus university, you need to put away about $1,000 per month from the time child's born until they head off to college, which is kind of a sobering number, particularly as a parent with other expenses coming down the way as well. But the good news is there are a number of saving tools. We've chosen to focus on the 529 in this presentation, but the 529 plan allows you to contribute money and it'll grow tax-free, and you'll provided with penalty-free withdrawals subject to their education expenses. The benefits being if it is owned by the individual who opens the account, not necessarily the child who may be the beneficiary. So you don't have to worry about turning over hundreds or thousands of dollars to a 6-year-old. An additional benefit is adding beneficiaries and changing beneficiaries. So we know that some kids won't attend college, whether they choose a different path or just don't have the interest. Ideally, kids get grants and scholarships, so you may not need quite as much as you need, but brothers, sisters, siblings, step siblings, you can all interchangeably change those beneficiaries, which is a nice flexibility option with the 529. On the savings contributions, you do get a state tax deduction in most states for the contributions that you make. So small wins wherever you can get them. You can use the 529 for K through 12 schooling. There is a cap on that limit, and you can pay for related expenses as well, such as sometimes computers, books, other things of that nature. One key feature that we did want to outline is the ability to roll over those funds to a Roth IRA. Now, there are a number of stipulations. You're subject to the maximum $7,000 cap that you contribute to a Roth. There needs to be some earned income, and there is that $35,000 lifetime rollover amount. But that does help stave off some of the issues of, have I saved too much? But you can eventually roll that over to a Roth and help set the child up for a success down the future in investing. The last point I'll make on this slide, sorry, Nick, if you can go back quickly, is just that it does accept third-party contributions. So if, again, you're like me and you have grandparents who are always asking, what can I get for your birthday? And you end up with these chintzy toys that you end up just stepping on and your child doesn't play with anymore. You can help and ask them to direct some of that money to the 529 and help you defray some of the savings costs and make them feel good about participating in the future of education. So we talked about what the 529 savings plan is. You should ask your advisor, what other options are there? What should I be thinking about and considering with the 529? Am I on track? We would note that your retirement should come as a priority to education savings. So ensure that you're not over saving for the 529 or the children versus your own retirement. How do I estimate those costs? And lastly, what can I do with the leftover money? Obviously, we've talked about updating the beneficiaries as well as rolling over to a Roth.
Good. Mike, I'm seeing some great questions come through the chat, so I think we'll buzz through the last couple sections relatively briefly just to make sure we have adequate time for Q&A.
Sounds good. Anytime I see this slide, I always think of a pillar. So we call this our pillar of protection slide, which is going to outline the main components of insurance. You're going to have different needs and different uses for various insurance policies with different phases of life. Obviously, the insurance landscape is ever changing. If you're sensing a trend, we would recommend that you work with a licensed professional who's familiar with your situation to make sure that you're well covered in each of these areas. Nick, if you flip to the next page, we'll focus on the property and casualty component of the insurance. Note, property and casualty is what protects your valuable assets, such as your home, car, personal belongings, and from damage and loss. So we do recommend an annual check-in with your advisor, making sure that you're getting regular coverage review, and that your asset values are reflected to help determine if your P&C is adequate. So with the last few years, we've certainly seen an increase in asset value. Many clients are finding themselves either underinsured or not insured for some of the things they thought they were paying for. That leads to coverage gaps, whether that be market value or replacement coverage. One example being if you've done a significant amount of home improvements or purchased high value items like jewelry, artwork, collectibles, that's likely a good indication you should look to at least update the policy to include some of those endorsements. It does feel like every time, let's talk about just the umbrella component. Umbrella insurance is really that low-hanging fruit in the insurance world. It does offer an additional layer of coverage beyond just your homeowner and auto insurance. We do recommend about 2 to 3 times your net worth. And it's a really simple and expensive way to add a layer of overarching protection to your insurance plan.
Great. Do you just want to touch on cybersecurity very briefly, Mike,
Yep.
and then get to Q&A?
Let's do it. So we did include some, with the data breaches and bad actors out there, we did include a few topics on how you can prevent, detect, and react. Obviously, using strong, unique passwords for accounts, enabling multi-factor authentication. While it can be really annoying, it is a free form of insurance and an additional protective layer. We would advise to be cautious with unsolicited emails and calls. So when you're getting texts for money or gift cards, or you have a long lost cousin who shows up, that should be a warning and a sign that you need to assign some further scrutiny there. So if you do detect some suspicious activity through the review of your credit cards, bank statements, or credit reports, certainly take those steps to protect yourself and follow up if you are a victim to identity theft.
Great. That's a great walkthrough, Mike. I think we covered a lot of very helpful, actionable planning insights, touching on a lot of key components of holistic wealth planning. As we noted at the beginning of the call, you can find more insights on our website, as we've noted here under the Insights tab. Please, with any questions or information, contact any of the professionals at Fiducian Advisors. So with that, we'll turn our attention to some of the questions that are in the chat box. One of the questions was any insight on the SALT cap. So that relates to the $10,000 cap for state and local taxes. That's going to be a key sticking point in negotiations as it relates to extending the personal tax provisions. There's currently 5 House Republicans that have said they're not on board with extending tax provisions until there's material change to the SALT cap, as they represent constituents from high tax states. There's been some discussion on increasing the cap from $10,000 to $20,000, which the Tax Policy Center has estimated would add about $225 billion to the federal debt if that cap was doubled. And those House Republicans from high tax states have said that simply doubling it to $20,000 doesn't go far enough. So certainly something that we're watching and will be a key component of negotiations. Mike, there's a question here on thoughts on aggressively converting traditional IRAs to Roth IRAs while income tax rates remain low from a historical perspective. Any thoughts on how individuals should think about partial Roth conversions?
Yeah, it certainly makes sense if you're looking to increase that diversification and if you can take advantage of those lower tax rates. Oftentimes, you want to convert when you're in a lower tax bracket than when you earn the money. So that's a win. The other key considerations would be if you see a nice market pullback to the tune of 5, 10, 15%, that's often a good time to convert some of those. So it's hard to say based on everyone's personal situation whether you should or shouldn't be aggressive with converting those, but we're certainly walking through that with clients. And as you start moving into retirement and potentially have less earned income and prior to having to take your required minimum distribution, it can be a really good planning tool.
There's a few questions here about the slides from today's presentation. The presentation that we've included today is a slimmed down list of our 2025 financial planning guide, which you can find again available on our website. There's a question about a spouse being able to take Social Security while the other spouse delays until after age 67 to get that annualized retirement credit. Yes, that is a possibility. Oftentimes you'll see the primary or the higher earning spouse delay to get that 8% annualized credit with the other spouse collecting. Just note that if the lower earning spouse collects benefits early, they'll also have a permanent reduction to their benefit as well as a reduction to the spousal benefit based on the higher earning spouse's earnings record. So bit of a nuanced planning question, great question. There's another question here in the chat about a Roth IRA being a good option for young kids when you're thinking about education planning or perhaps planning for the future. One of the key planning points there is that the child has to have earned income. So you can't just go ahead and contribute to a Roth IRA, for example, for a young child that may not have earned income. The 529 plan is really a great option for saving for future education costs, as Mike did a great job explaining. Mike, anything you'd add on thoughts and considerations for 529s and saving for college expenses?
No, I was just going to comment on the Roth. Obviously, we love to get money into a Roth as soon as you can, but as you alluded to, you've got to have that earned income, which can be difficult to justify, at least in the eyes of the IRS. There's one more question
ahead,
from the umbrella coverage that we briefly went over. So 2 to 3 times your net worth. That does include your IRAs and trusts. You do have some built-in protection with the IRAs, depending on the state that you're in. 401ks are much more protected given ERISA rules, but that should be included in that number as depending on the lawsuit that is filed against you, they'll certainly could look at those assets.
And that's just a general rule of thumb, so that 2 to 3 times can vary, greatly depending on the size of your net worth. So for someone that has a net worth of 20 or $30 million, that may be a much more costlier proposition than, for example, someone that maybe has a $1 or $2 million net worth. Mike, there's a question here on when you're thinking about charitable planning, how do you rank qualified charitable distributions versus other options? Do you want to touch on that?
Yeah, I think that is in large part comes down to what your income looks like. So we do have a number of clients who utilize those QCDs that have high income. Obviously, taking money out of the IRA is going to count. And when you take the money out for your required minimum distribution, it's going to count as ordinary income. And so by giving that directly to charity can be a really elegant and efficient way to circumvent some of that. But as Nick alluded to, gifting appreciated shares, particularly in the environment today where there has been a lot of gains over the last decade, as an executive, sometimes we've seen very concentrated stock positions that can be very good candidates to gift to either a donor advised fund or just gifting in general. So it's not the end all be all, but we do see a lot of the QCDs, qualified charitable distributions, and they're very good options for certain situations.
And I would just quickly add, for those that may not be familiar with the qualified charitable distribution, it's available to individuals that are at least age 70 and a half. That limit is now indexed for inflation. So for 2025, the limit's $108,000 that you could donate from an IRA directly to a public charity. Important to note, we're frequently asked, hey, can I go ahead and do a QCD to my donor advised fund? That's specifically prohibited. So you have to go ahead and make the distribution to a 501c3 other than a donor advised fund.
One more, it looks like on property and casualty. We skipped over that pretty quickly, so I think this is a good question.
Sure.
The question was, insurance companies often increase premiums or even drop coverage, even if the policyholder isn't at fault. What would you recommend for dealing with this? Unfortunately, that's a abundant issue that's touching a lot of folks. That we briefly mentioned that with the natural disasters, there are states in general, think California, Florida, Utah, that are just you can't get insurance in anymore. So unfortunately, or fortunately, we found some ways and some different insurers with our partner NFP. But it's a difficult situation that many people are finding themselves in. And I think certainly if you're going to be purchasing new property or living in states where that is a risk, it's certainly taking time to understand that situation. So we don't have a great question, or we don't have a great answer for that, but it's working with your insurance provider and making sure that you are evaluating what options, whether that be paying more for the premium or even doing some self-insurance.
Then there's a great question here on long-term care insurance. Just at what age should you think about taking out a long-term care insurance policy? That market's become more difficult just because insurers materially underpriced long-term care insurance throughout the 1990s and going forward. So you've seen a pretty material increase in premiums for those that want to have long-term care policies. So typically it's a discussion that needs to be had. Mike, wouldn't you say probably between ages 50 to 55? You don't want to wait too long, but you also want to be thoughtful about not taking it out too early.
Yep, I think that's a good rule of thumb.
And we've seen a number of individuals actually pivot to taking out a life insurance policy that's a hybrid policy that will allow for advancement against the death benefit for long-term care needs. So given some of the challenges within the long-term care market, those hybrid insurance-based products have become more popular here in recent years.
And Nick, I think we're coming up against time here, but
Yep.
one other question just on annual exclusion gifts. Why should you do those? In what situation would you be using those, and what's the purpose?
Yeah, it's a great question. I think it's particularly helpful for an individual that might be on the cusp of having a taxable estate, but might be a little bit fearful of, do I have enough assets to retire? Whereas the annual exclusion gift limit is $19,000 per beneficiary. So as a couple, you could gift up to $38,000. So it's a great opportunity to perhaps chip away at what could be a taxable estate, but not necessarily giving away a huge portion of your assets if you're concerned about retirement asset sufficiency. The other planning point would be for those that have already exhausted their lifetime gift exemption amount, that the annual exclusion really gives an opportunity to continue to chip away at a taxable estate. So where we see this is ultra high net worth clients that have a taxable estate. They've used up that gift exemption every year. Let's say as a married couple, you're giving away $38,000 to a pool of family and friends. And when done consistently over a period of years, that can amass to a pretty big amount that you've given over time. Well, good. Well, I think we're up on time. We appreciate everyone joining today's call. As always, please feel free to reach out to any of the professionals at Fiducian Advisors with any follow-up questions.